Hey everyone, today we're diving deep into the world of Singapore real estate investment trusts. If you're looking for stable income and potential growth in your investments, S-REITs are definitely worth understanding. We've just wrapped up the first half of 2025, and despite some global economic wobbles, the S-REIT sector has shown incredible resilience. In fact, the top 5 performers have delivered double-digit returns. So let's break down what happened and which REITs are leading the pack. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Let's talk about the big picture. The IHS REIT Leaders Index, which is basically a benchmark for the sector, started 2025 pretty steady. But then, from April to June, it really took off, surging by over 11.7%. This wasn't just a few lucky players. More than half of the 30 REITs in this index actually saw positive returns. That tells us there's a broad positive trend happening across the sector. Now, you might be wondering about interest rates. They've been a big topic, right? While the US Federal Reserve hasn't cut rates yet this year, the market is definitely expecting them to later in 2025. And here in Singapore, our local interest rates, known as SORA, have actually been falling. They dropped from over 3% in January to just over 2% by the end of June. Why is this good for REITs? Well, REITs often borrow money to buy and manage properties. Lower interest rates mean lower borrowing costs for them, which can boost their profits and the money they can pay out to investors. Interestingly, this drop in local rates hasn't fully translated into higher unit prices yet, which could mean there's still some hidden potential for growth. Let's look at who's buying and selling. In the first half of 2025, everyday investors like you and me were quite confident, pouring about 400 million Singapore dollars into S-REITs. On the flip side, big institutional investors like pension funds were initially net sellers, pulling out over 500 million Singapore dollars. But here's the interesting part. Towards late June, these big players started to reverse course and became net buyers again. In some of our top-performing REITs, like Capital and Integrated Commercial Trust, Fraser's Hospitality Trust, and Parkway Life REIT actually saw net inflows from institutions throughout the first half. This suggests that while some institutions might have been cautious, they're now selectively investing in the strongest, highest quality REITs. It's a good sign for the sector's overall health. And speaking of good signs, S-REITs are currently looking quite attractive from a valuation perspective. The sector's price-to-book ratio is below 0.8 times, which is lower than its 10-year average of 1.0. In simple terms, this means they might be undervalued compared to their historical performance. Plus, the dividend yield for the IHS REITs Leaders Index is around 6%, giving you a significant yield spread of almost 4 percentage points over Singapore government bonds. That's a pretty sweet deal for income-focused investors. All right, the moment you've been waiting for. Let's reveal the top 5 REITs that truly shone in the first half of 2025 based on their year-to-date total returns as of June 26th. With an impressive 21.4% YTD total return is Fraser's Hospitality Trust. This trust owns 14 hotels and serviced residences across Asia, Australia, and Europe. Their incredible performance was mainly driven by a proposed privatization, which basically means another company is looking to buy them out, usually at a premium. This kind of corporate action can really boost a stock's price. Next, we have Capital and Integrated Commercial Trust with a solid 13.8% YTD return. This is Singapore's largest REIT with a massive portfolio of 21 properties in Singapore, plus others in Germany and Australia, including a mix of offices and integrated developments. CICT's success comes from strong consumer spending and high demand for their spaces, leading to consistent growth in their income. Coming in third is S-REIT, with a 10.7% YTD return and the highest dividend yield among these top performers at 8.7%. As Singapore's first healthcare REIT, they own hospitals and nursing homes in Indonesia, Singapore, and Japan. Their defensive healthcare focus means stable income, and they've been strategically expanding into developed markets to strengthen their portfolio. Then we have Frasers Centrepoint Trust, delivering a 10.4% YTD return. FCT is one of Singapore's biggest owners of suburban retail malls like Causeway Point and Next. Their malls are located near homes and transport, focusing on daily necessities, which has kept their occupancy rates incredibly high at 99.5% and allowed them to increase rents. And finally, Parkway Life Real Estate Investment Trust with a 10% YTD return. Pratt is one of Asia's largest healthcare REITs, with most of its assets in Singapore and Japan, including major private hospitals like Mount Elizabeth and Gleneagles. Their growth is driven by the stable demand for healthcare services and smart acquisitions, like new nursing homes in Japan and France. So, what's the secret sauce behind these top performers? It's a mix of things. All of them showed strong operational results, like keeping their properties highly occupied and successfully increasing rents. Think of it like a landlord always having tenants and being able to charge a bit more each year. Many also grew through smart acquisitions or by improving their existing properties. But some had unique catalysts. For Frasers Hospitality Trust, it was that proposed privatization that really sent its stock soaring. For S-REIT, expanding into new, stable markets like Japan was a key driver. Meanwhile, CICT, FCT, and PREIT simply excelled at managing their existing assets, benefiting from strong demand in their specific sectors: resilient retail, suburban convenience, and stable healthcare. It just goes to show there's no single path to success in the REIT world. Looking ahead, the future for S-REIT seems bright. With expectations of U.S. interest rate cuts and Singapore's SORA already falling, borrowing costs for REITs should continue to ease, which is great for their bottom line. And remember those attractive valuations? The sector is still trading at a discount compared to its historical average, and the dividend yields are very compelling compared to government bonds. This suggests there's still room for growth and strong income potential. In conclusion, the first half of 2025 was a strong period for Singapore REITs, proving their resilience and ability to deliver returns. The top five, including Frasers Hospitality Trust, Capital, and Integrated Commercial Trust, S-REIT, Frasers Centrepoint Trust, and Parkway Life Real Estate Investment Trust, led the way with impressive double-digit gains. Their success was built on solid operations, smart strategies, and sometimes unique corporate events. With interest rates easing and attractive valuations, S-REITs continue to offer diverse opportunities for investors seeking both stable income and long-term capital appreciation. That's all for today's deep dive into S-REITs. If you found this helpful, hit that like button, subscribe for more insights, and let us know in the comments which S-REIT you're watching. Thanks for tuning in, and we'll see you next time.